is this: for bar chart homework assignment 3, you need to start with homework 2 conclusions. That means you were saying that, well, you had an asset which has been identified as normal contango. And then you found out that the basis is downward sloping. So how are you going to react to this combination of facts? Homework 2 says normal contango, and basis is saying it's downward sloping. In order to conclude that, well, it's an investment decision to the short side, the basis must have been going up. So you say that my necessary conditions, that is homework 2, is satisfied, therefore we call this as a normal contango market. But our basis is downward sloping, therefore it failed the sufficient condition of homework 3. And so combination wise, I do not recommend investments. I say continue to hedge this market. There is no chance for investments. And then you take that thing and do you do for the other 2 assets, and then you say, okay, fine, now that I have that, I can say what MG did do and did not do. MG was right in identifying the market. That is, MG did homework 2. But they did not do homework 3, which is basis and basis check. And basis check tells you basically market movement. It's a difference between spot and futures over time. So it is saying how the nature of relationship between spot and futures are changing over time. And that will bring in the concept of volatility. So they did not check whether the market has danger ahead. And the danger is the risk. And the risk can be identified by looking at the basis slope. And so when they did not do, what happened was market did flip. That is, they identified the market right, which is normal backwardation. Then it turned into normal contango. And in a normal contango market, futures start higher and it starts to drop down. And when futures is falling, it is because the price underlying is falling. And so when they invested on the long side, their long side is losing. And they had another problem. MG had another problem, that their initial position was short because they are the supplier of energy products. So when their initial stage, they took a forward contract and short forward contract. So they are good in that. In their core business, they're good. They guaranteed the price at which they are going to sell their energy products to the clients. In the part that is the hedging part. The core product is good. But on the investment side, when they invested on the futures side, which is the short-term one, they made a big mistake. They are partially correct in adapting the theory, because theory says that you not only have to identify this market, but you also have to make sure the risk is calibrated. That means in pure English, is there any danger ahead? So I was giving an example earlier that in finance, if you do just the return analysis and no risk, that means if you are just looking at the mean return and no sigma, then you are not doing finance. This is the ABC of finance, where you have to look at 2 sides, return and risk. So you have heard stories about these cryptocurrencies. People are becoming millionaire who are doing nothing in their real life. and you look at the return story, but you do not see that what is the danger ahead. And you now see that the particularly case I'm mentioning is Dogecoin, where you make millions and then suddenly it lost 50% of its value. And then you say, buy more because it is now cheaper. And then this is a classic mistake. You continue to buy more and lose more money. So you need to understand that MG, even though this is, I'm talking about regular folks who are making this kind of mistake, that means going into something that has return and not considering the risk. And even the stalwart like MG, they made the same mistake. That is, they looked at the return side of branding the market as normal backwardation, and they were great in that, but they did not do the risk analysis, which is the basis analysis. And so they could have seen this very clearly, that it is going to, there will be danger ahead. And if when you see danger ahead, you do the risk management. And so I have a question, in fact, question as well as comment, that what do you think that if you, let's say, turn back the time and you tell them that, well, can you please go ahead with the same data available in 92? Can you check your basis? What do you think that you would see the basis as? Downward sloping or upward sloping?
Like you said, that the market changed to contango. It was backwardation, but then it changed to contango. In that case, I would see the basis downward sloping.
So if you see the basis downward sloping,
I'm sorry, upward sloping. Sorry.
Yeah, yes. Then that would have put their recommendation right on total halt, right? Yes. Or they could have said, okay, I'm willing to take the risk. People do take the risk, right? Mm-hmm. After they know the risk, isn't it? I mean, and you folks are in that business. You calibrated the risk and then, okay, we're going in. What do? You do some risk management, isn't it?
Exactly, yes.
And that is what they could have done. But there is no sight of it. No sight of risk management.
Was it because that at that time period, basis analysis was not that, I would say, like in practice?
Yeah, you have a point there. But the standard finance is simply risk and return. It's not blaming. When you take a case and illustrate the case, you try to learn from it. And what they have not done is the pure standard finance. They looked at avant-garde. This is an avant-garde theory, normal backwardation, and they said, okay, go for it. So they just went for it. But they should have thought, as a student of finance, they should have thought that, what is the risk in here? I'm just painting a rosy picture, but what is the risk in here? And if they had looked into it, they could have found it. And if there is no practice in that, they could have devised that risk management. Let's say you are moving into some area which is highly risky, and there was no risk metric for you. What do you say? I don't care about risk metric. I will just jump in. Do you do that?
No. I look into the situation and try to analyze the risk.
Yeah, and you try to invent one if there is no metric, but still you want to do something, right? You just
Take some precautions.
Yeah. And then from you, people learn, people look at this situation and then, well, yeah, it worked or it did not work too well. And then they try to improve and an organized form of metric develops, right? So that is the part, I mean, that you say that cryptocurrency is a brand new one. And can we apply the same risk metric for cryptocurrency as we do for stocks? Maybe, but still you apply it. Maybe imperfect, apply it. Then you make it more relevant. So bottom line is that you do 3 bases. And then in conjunction with homework 2 conclusions, you tell that, well, there is a case for investment or there is no case for investment. I know, I know Josh sent me an email saying that, well, he had identified all the market to be, according to him, all the market to be mixed market because necessary conditions for all 3 markets were not fulfilled. If one is fulfilled, but the other is not fulfilled. And so if you take that to be correct identification, that in this case, you do the basis for academic reason here. Why? The necessary condition failed. So you do the basis and then you say this way, that had it been identified as normal backwardation or normal contango, then with this basis, we could have invested. Let's say your basis comes out to be downward sloping. Then you say that, well, the market were all mixed markets, so there is no case for investment because necessary condition failed. But had we had that market to be normal backwardation, then this basis would have supported long investment. Make sense?
Yes. Yeah.
Even though this is an academic exercise at this point, because necessary and sufficient conditions have to be fulfilled. Both necessary conditions have to be fulfilled in order to identify or brand the market. And then basis has to be fulfilled in addition. It's just like that. I mean, those of you who, I know you have a background, you have an engineering background, correct, Nasif?
Yes.
Yeah, so for people who are inclined and took some calculus course and so forth, they know that if you want to know whether you have reached the peak or you maximize things, how do you know? You say that, well, first of all, a peak or a valley has a slope of 0. Okay? Because it's a flat line, a peak or valley. Otherwise, it will be upward sloping and then downward sloping, right? But at the peak or at the valley, it is 0 slope. So necessary condition to be either on the peak or a valley has to be equal to 0. But how do you know whether you reach the peak or whether you are at the valley? You say that, well, if the derivatives, second derivatives is less than 0, that means it is falling, then you know you have reached the peak. If it is rising, then you know that you have reached the bottom. I just wanted to add that to it if those of you who know about the slopes can convince yourself what it means. That is, just the necessary condition will give you either the peak or the bottom. And it makes all the difference. You want to reach the peak, not the bottom. So it is the sufficient condition that will tell you whether you have reached the top or the bottom. I hear the silence, Nasif, so I think that example was not a good one.
No, it was. Since you were talking about the slope, I just had another question in mind that I was doing when I was doing soybean.
Hmm.
And so we talked about normal backwardation and normal contango, these two situations, and even mixed market. And based on that, we expect either the slope will be steeping up or steeping down. What if it's not steep slope? What if it's like you see it doesn't have like a perfect going up or perfect going down?
Yeah.
In that case, what?
So that is a weak case. That is a weak case of, we're human beings. We have a perception of risk, not only the risk measurement, the objective risk measurement, but also the perception, both. So your risk measurement says it is weakly downward sloping or weakly upward sloping. Then you have to apply your perception. Do you think that this is good enough? Don't forget that element in you, that you are a human being. Only the science will not make you invest, right?
Exactly.
We call this risk aversion. What kind of risk aversion you have? I mean, I give an example. This example I think it will sit better. There used to be a game called Let's Make a Deal, which came back as a new form of Let's Make a Deal. The whole thing is, if you're lucky, you go into the auditorium. So let's say there are 300 people in the auditorium. Now, once you are in the auditorium, your name can be called. When your name is called, you go to the MC, and MC takes, let's say, just I'm giving an example, 600 brand new $100 brand new. You can smell that $100, and tell you, just because you're here, you have a choice to make. Choice is this: you can either take this $600 and leave, nothing asked, just leave with $600, or you can say that this is the risk-free, right? This is right. This risk-free 600, or you are given a risky choice, and that risky choice is this: you see in front of you there are two doors. One door has about $10,000 worth of goods behind the door, and the other has just the grass, not this expensive kind. I mean, just the grass. If you somehow choose the wrong door, that means the grass one, you have to clean up the grass. So you have come here with the hope that to get some money, but you are going into risky venture, and in that risky venture you can get $10,000, which is way, way, way above $600, or you can get a negative return, which is basically you have to clean up. Which one would you do? Do you think that everybody opted for $600?
No, there are people.
So
I'm pretty sure they played, yeah.
Yeah, why?
Because the reward is much, even with the risk, the reward is even bigger. It's proportional to
fine.
the risk.
But what is the difference? Is the risk condition different from two different people, or they're looking at the same risk?
I would say it's a perception thing.
Exactly. So no matter how objectively you do things in finance, all the data are the same, facing all different individuals. But it is the human element that comes into play ultimately. And that is, what do I consider? Is it weekly downward sloping is okay? Weekly upward sloping is okay? So, but if you want to be very concrete, you said, no, I will not entertain any kind of risk aversion to the picture. No human element into the picture. It will be robotic investment. So in that case, you say, Well, I will set my program to extremely downward sloping, extremely upward sloping. It is robotic investment in that case, you know.
Gotcha. Yeah. Totally makes sense.
Yeah.
Thank you, Professor. Yeah, it cleared up a lot of things that I had questions about.
Okay. So after this, I'm going to put this up on your canvas and communicate that to Josh. It's there. Okay. All right.
And Professor,
Any other
before you,
question?
yeah, one last question before you leave. It's for the next week. I'm kind of ahead of it, but it says on the assignments that there is a report that we have to write next week, but it's a group thing, but we didn't see anything on the group.
Okay. Basically, I did not form any group. Just give me a second. Because you are the
Right,
only two
exactly.
people. Yeah. But let me see. Just give me a second. No, there is a group.
Okay.
Yeah, there is a group.
So basically,
let me see. Hold on. Josh is doing EEM and you are doing EMB. And where do you get that? I'm coming to that. But you do your things, okay? And then in a combined group, you just combine it, both of you. So let me take you there. So your asset is EMB. So you see in reference materials, that's what this is. So you need to look into this, do the research and find out what this will help. So basically you are basically editing this one report already for you. Basically update and make your predictions. And in there, you see all of those. So fundamental analysis. First of all, you make sure who does that. That's what you do. And then you give the table of contents. First is executive summary, then fundamental analysis, technical analysis, risk management analysis, and mindset analysis. And then because we are a school with a mission, and mission is we always, whatever things we do, we make sure that it does basically what we say, there is a common good element in it, that is, it is going to affect people in the right way. And the other part is that it provides dignity to the human being. So like you see in their ESG analysis, they put it this way. It's in our mission. So you see, two elements, human dignity and the common good. So it's very important that, well, that your investment also pass master the test. Okay, so you need to just update this. And then after you do this, you submit, and I'll go to the module now one more time. And for Josh, it would, let me go back.
Update that on that file, right?
Yeah. You can keep the same format and so forth, but you can also change the format according to your way. But I have no preference. But I think whatever you do, instead of just, if you don't do it your own way, your learning is limited. So here they have a different way of stating things. And and then again, same thing, executive summary, allocation, final mindset, all of those. And what did they do? Enter short position, and then date of last this April, and then same way they dealt with ESG right at the front. And I prefer right at the front, not at the back. So no, they missed the ESG part. They did not mention ESG. So whenever you choose the thing in fundamental analysis, you mentioned that we also, in addition to regular return, we also seek, no, here. No, sorry. So you say that in fundamental analysis, yes, we recommend this to be long thing for EMB, but we also know from ETF.com, that is where you will get all the data, most of the data. So in ETF.com, they say that, well, this it is also ESG compliant or not ESG compliant. And if it is ESG compliant, that means we are addressing our mission. Okay, and let me now look at the submissions that you talked about. We are in the June this week, next week, right?
Yeah, it's just like individual group or something. Yeah, that one, the last one.
Yeah. So you can put your EMB. Just edit that. Yeah,
okay.
And then thereafter, group. This is individual for report, and then group means you combine the two, making sure that they, let's say in EMB, you think that there is some risk management to be taken, but then again, when you put the two together, you say that, well, they can also diversify each other. Diversification, that is, if you take one stock versus if you take 40 stocks. Yeah. So that's the part, and that's the risk for the group. Only additional work, except for blending the two together, only additional work is to check whether EMB plus EEM is a better curve than EEM or EMB in isolation. When I say better curve, meaning that is just the way you are doing the basis. You are saying spot minus futures. Instead of saying that, you say in there EMB plus EEM. And once you see that together the portfolio is upward sloping or downward sloping or flat, if it is flat, you say it is diversifying each other well. If it is upward sloping, that means it is not only diversifying, but also yielding together as a portfolio. As a portfolio manager, you see that, well, both of them together are synergistic. If it is downward sloping, that means they are basically risky in a portfolio together. Hello?
Yeah. So yeah, I will do that, and if I have any question, I will just shoot you an email.
Yeah. Sure,
regarding that.
sure.
Thank you,
And
Professor.
yeah, and it will be on your canvas, right?
Right.
On
Thank you so much.
the reference section. Okay, thank you.